If you clicked on this video, you're probably a newcomer to Canada who wants to know what you should know from a money perspective in order to get ahead or at least get on track to having a successful future. And that's exactly what we're going to be covering in today's video. There's going to be a lot of beginner friendly and foundational information for anyone who's trying to build their financial building blocks and for anyone who wants a full overview of how the North American financial system works. I think that this is one of the most important topics for so many people, mainly because I also came here as an immigrant with my parents when I was just 6 years old. And something that I always say, and I think that this goes for anyone, literally regardless of who you are, that was not taught anything about money up until finding our channel, is that just like my parents, there are so many people who would be so much further ahead in life had they been taught the basics in a simple way 20 to 30 years ago. And I think that that's exactly what we want you to take away after you watch this entire video. My personal journey with money has actually been a really interesting one. And for anyone who's interested in hearing like the full backstory of how I got to where I am today, you can actually check out this video that we did a few years ago. But in general, it's been a slow process of accumulating knowledge over time and just asking a lot of questions. If you're moving to Canada or if you've recently arrived, you're probably learning a lot, or better yet, you're probably finding yourself in a position where you're asking a ton of questions on how the banking system works, how people handle their finances, or even just how general life here in Canada is. Now, newcomers are all going to start in very different places, especially depending on what brought you here in the first place. For some of you watching, you might be an international student who's here to study, or you might be someone who's here to work under a variety of different statuses. No matter where you're at, it's going to be very important for you to understand how, one, the general banking system works, 2, how credit cards and the credit system work, 3, how taxes work, and 4, how saving and investing work as well. And that's exactly what we're gonna be covering in today's video. So the first thing that we need to cover in order to set the stage for how everything works is the banking system. One of the main things that you have to understand about the banking system, or banks in general here in Canada, is that they are regulated by the government, which means that you as a newcomer should feel comfortable putting and keeping your money in a bank or even a credit union. Now, if you're wondering what the difference between a bank and a credit union is, you're not alone. For the most part, their goals are very similar in that they're both secure places for you to keep your money, and they also allow you to meet your everyday financial needs. So for example, that could be having access to your money, using your debit or your credit card, and more. The main difference between banks and credit unions is that banks are for-profit organizations, meaning that they want to and have to make money for their shareholders. Whereas credit unions, they're not for-profit organizations, meaning that their mission mainly is to deliver good services to their community, and then making money is not a priority beyond helping its members. When it comes to who should use one or the other, it's ultimately up to you. Banks are great because they're easily accessible, they often have more products and services available, and they also typically have a larger national and global presence. So think access to ATMs and other online services. With banks, you don't need to live within a certain geographic community to access their services. And kind of like what I just touched on, they usually have the best online services and apps. And in the case of digital banks, which we'll talk about in a second, they also have no fee banking, which is amazing. Credit unions, on the other hand, are very community focused, and they offer great deals to anyone that belongs to their local geographic area. They're also more likely to work with anyone who has poor credit, which does happen to a lot of people, including newcomers, who don't quite know how the credit system works just yet. Also with credit unions, you're actually not a customer, instead you're a member. This means that you pay a one-time membership fee that usually ranges from $1 to $25, and then that's it. You're in. For the most part, when it comes to fees, you're honestly in good hands at a credit union because they're known for having little to no fees for their products and services, unlike the big banks who are known to charge you for pretty much every little thing. Overall, credit unions are great because they service local people, and because they're not for profit, they usually have great customer service whose goal is to help its members as opposed to signing you up for pretty much as many products as they can. Steph and I personally use banks, specifically digital banks like Simply Financial, who offer no fee banking, meaning that you don't have to pay a monthly fee in order to keep your money at the bank, and you get all the benefits that come with being with a bank.
Now, when it comes to banking options in Canada, there are 5 major banks that you've likely heard of before: TD Bank, CIBC, RBC, Scotiabank, and BMO. Now, the reason that they're known as the Big 5 banks is because they have a very large presence both nationally and globally. So what this means is that they have a lot of customers, and they also make the most money out of all the other banks in Canada. Now, don't get confused here because this doesn't mean that they're the best banks. A lot of people bank with these banks specifically because their family and friends have always banked with them, which also typically means that they don't have to offer the best value to customers because they know that a lot of their customers will never leave and will just accept the status quo. In other words, when you hear people say things like, "Oh, it's always been like that," Of course, it's never going to change. Now, these banks being so big and having a lot of money also allows them to spend a lot more money on advertising and on getting their brand out there. But once again, there are so many other options available that people either dismiss or they just don't think about, maybe because they don't think that they're as safe or just because your family and friends are telling you that the big 5 banks are the best. Now, before we even get into the different banks and also the different types of accounts, you should know that when it comes to the safety of your money, there's an organization in Canada called CDIC, or the Canada Deposit Insurance Corporation, and they guarantee your money. So for example, if you deposit your money at a bank, no matter how small that amount of money is, if the bank that you choose to use ever were to fail, CDIC guarantees that they'll cover the money that you had in your accounts up to a maximum of $100,000. Now, it's definitely important to mention that there actually hasn't been a bank failure in Canada since 1996, but if there ever was one, and we've definitely seen this happen in other countries around the world since then, CDIC would be there. They cover 9 different account types or categories as long as your money is held within those accounts at one of their member Canadian banks or federally regulated credit unions. Now, if you want to know if a bank is actually a CDIC member, then you can look for this purple lock symbol, or you can also go to the CDIC website and search their list of members. Now, there's also provincial credit unions, and a lot of them are also covered and insured, just not by CDIC. All the different provinces have their own organization that does something similar. Now, as a newcomer, one of the first things that you'll want to open once you're relatively settled is a bank account, and specifically a checking account. Now, in Canada, we have 35 domestic banks, 3 federally regulated credit unions, and 696 provincially regulated credit unions, so basically you have a lot of options to choose from. Like we mentioned earlier, we personally use digital banks, and like the name suggests, they're online only, and they typically have no fees for most of their accounts, which is one of the main reasons why we really like them. Now, if you're someone who feels like you need to bank with a bank that has an actual physical presence, you can still use a few different digital banks, like for example, Simply Financial and Tangerine. They're actually associated and owned by some of the big banks, specifically CIBC and Scotiabank. So if you ever needed to use an ATM, you could actually use the CIBC and Scotiabank ATMs. Now, other than a checking account, the other type of bank account that you might want to consider opening up is called a savings account. Now, on top of anything specific that you might be saving up for, you'll ideally also set some money aside in your savings that you don't touch or spend unless an emergency comes up. This is called an emergency fund. There's a lot of other topics and things we could go into when it comes to saving money, so make sure you check out some of the other videos on our channel about saving and budgeting too.
So that more or less covers the general banking system in Canada, which should help you keep your money. Now let's talk about spending your money and how the credit system works. For the most part, when it comes to buying almost anything, there are 3 main ways that people will typically pay for things. 1 is using cash. 2 is using your debit card, so money that directly belongs to you and it is in your bank account. And then 3, using a credit card, so money that does not belong to you. And by the way, this is a very important distinction. In Canada, credit refers to borrowing money from a bank or a credit company. It's basically this all-encompassing word that's used to describe a promise to pay back money that you borrowed on a specific schedule. Now, your credit score or your credit history, that's what shows how well you handle your money. Borrowed money specifically. It basically tells lenders, so we're talking credit card companies, banks, and loan providers, or anyone that cares, whether you're someone who pays back debts on time. Now, the credit score, on the other hand, that actually tells lenders specifically if you're someone that they should lend money to, or if you're someone that they should actually give a credit card to. In general, understanding how the credit system works and how to build up a good credit score is essential for things like borrowing money, renting certain apartments, buying a home in the future, and avoiding dangerous debt cycles, all of which are things we're gonna discuss right now. I know that for me and Steph, when we first moved to Toronto, one of the main things that our landlord asked for were our credit scores. And he basically wanted to make sure that they were high enough and in good standing so that he could actually trust that we were gonna pay him rent every single month. Anyways, let's start off with talking about credit cards, which by the way are a very important financial tool, and how you can actually use them to build up your credit score. Now, when it comes to talking about credit cards, there's actually a couple things that we need to discuss. Number 1 is what they're for. Number 2 is how you can go about using them. And number 3 is how you can actually get one. A credit card and a debit card are very similar in that they're both pieces of plastic where when you swipe or tap them, you can pay for almost anything. And you can also use them digitally because they're recognized by a unique set of numbers that they have on them. But the key thing that you have to remember is that the funds that you have on the credit card, Those aren't your funds. With a credit card, the bank or whoever issued the card has to first approve you and your application, and then they usually set a limit on how much you can actually spend using the credit card based on your credit history. Now, if you compare that to a debit card, there's no specific limit on how much money you can actually spend. In theory, you could actually spend all the money that you have available in that account because it's your real money that you already made and that you have in that account. But you notice that I said in theory because there are daily limits that the bank sets. Now, the reason they do that is for your own protection because, for example, let's say you lost your debit card, you probably wouldn't want someone to find it and then just spend all of your money in that one day. A credit card is different because the lender sets a limit based on the type of card and how they view you. For example, when I got my first credit card when I was 18 years old, I was approved for a credit card by my bank. But the limit that they set on that credit card was only $1,000. Now, that could be $500 for some people, it could even be less for some people. Now, the reason that they set the limit to $1,000 was because at the time, I didn't have any credit history. Basically, the bank pulled my credit report, and we'll explain how you can get yours in a second. And what they saw was that I had never borrowed money, I had never had any credit cards, I had never purchased a car using a loan. I basically didn't have anything credit related at all. I mean, at the time, if you think about it, I was only 18 years old and was just beginning my adult life. Given the lack of information or proof that I was someone who would actually pay back my borrowed money, they decided to say, hey, let's give him a $1,000 credit card limit. Let's see how he does. Maybe in the future, we'll give him a credit limit increase.
Now let's talk about how using a credit card actually works. As you might have caught on to by now or guessed, a credit card isn't some magical card with unlimited amounts of money for you to use. There's a lot of things that are very important for you to know and also some fine print for us to go over. Even though a credit card provider, so a bank or another financial institution, will give you a credit card with a specific limit on it and they expect you to pay it back, they technically don't actually want you to pay it back on time because if you don't, they get to charge you interest for being late or for not paying at all. Now, we're telling you this not to scare you, but because it's important to know that this is how this works. Banks and credit card companies, many different financial institutions are selling you products and looking to make money off of you, right? And credit cards happen to be one of the biggest money makers. So it's important that you know what to look out for and also how to take care of yourself and your money. So the main thing to know so far is that it's very important to pay off your credit card. Now, when it comes to paying off your credit card, here's how it works. Every card has what's called a billing cycle, and it usually lasts for 1 month. So what that means is that each and every month, as you use your credit card to spend, so whether that's to buy groceries, clothing, pay off your other bills, whatever it might be, at the end of that cycle, at the end of the month, the credit card company will give you your bill. It could be via email or they could give you a paper copy. Now, your bill will outline exactly how much money you spent and on what over the past 30 days, and then it will also tell you how much money you have to pay them within the next 21 days. Now, those 21 days are what's known as the grace period. And during that grace period, you won't have to pay any interest on top of the money that you currently owe, even if you keep using your credit card. But the longer that you take to actually pay off your balance and pay the money that they need you to within that billing cycle back, the more the interest will start to grow and the more money you'll owe in the future. Also, on your credit card statement, which is what the bill is actually called, you'll see 3 different amounts. You'll see the statement balance or the full amount. You'll also see the current balance and you'll see the minimum balance. The statement balance tells you how much money you owe from the previous month's billing cycle. Now, technically, that's all you actually owe and therefore need to pay. On the other hand, the current balance tells you how much you owe from the previous month's billing cycle and anything else that you've spent since then. Now, here's what you should ideally be doing from our perspective. You should be paying off the current balance a month, so whatever the entire current balance says, multiple times a month, maybe at the end of each week, to avoid paying any unnecessary fees or other penalty charges. Now, the minimum balance is the smallest amount of money that you can pay. Typically, it's $10 in order to remain in good standing with the bank or credit card company. Now, if you pay the minimum amount, you've made your payment on time, but not in full, meaning that you're going to be charged interest on the remaining balance, and the amount of money that you owe is going to go up each month. The benefit of at least paying the minimum balance is that the bank won't report you for being late on your payment, but you also don't want to go into debt for not paying off your credit card. Also, if you're wondering how you can pay your credit card balance off, it's actually really simple. You can typically send a transfer from your checking account to your credit card account, or you can create a bill payment and pay off your credit card that way, especially if the card you have isn't with the bank that you use. We also really want to reiterate here that money that you spend on a credit card does not belong to you. It's debt, plain and simple. This means that ideally you shouldn't be spending any money on it that you don't already have in your bank account. We personally look at our credit cards as just an extension of our checking account, and we only use it to pay for our everyday expenses and only on things that we can afford to pay off. Now, the reason that this is so important is because credit card interest rates in Canada are very high. The average is between 19.99% to 25.99%, with 19.99% being the most common. So for example, that means that if you spend $100 and you're late on your payment, you're going to be charged at least $20, which, as you can imagine, adds up very, very quickly.
On top of trying to avoid paying high interest rates and going into debt, you also want to make sure that you're building up a good credit score and not a bad credit score. There are 5 different things that all make up and impact your credit score. Number 1 is payment history. Number 2 is amounts owed. Number 3 is length of credit history. Number 4 is types of credit. And number 5 is new credit. By the way, we're gonna break all of those down right now. Your payment history is your ability to pay your bills on time. Now, this is the biggest factor at 35%, and this has a huge impact on what your credit score will look like. Amounts owed is also called credit utilization, and this one basically compares the amount of credit that you've used versus the amount of credit that you actually have available, so your total limit. Now, if we go back to that example of when I got my first credit card, basically the bank gave me a credit card with a limit of $1,000. Now, even though I had that much available to spend, you don't actually want to use all of your available limit or your available credit. Basically, you want to have no more than 30% credit utilization. So for example, once again, if you have a credit card with a limit of $1,000, you don't want more than $300 sitting on that credit card without it being paid off. And also, this is the second highest, I guess, factor at 30% on your credit score. Length of credit history, which accounts for 15%, refers to how long you've had credit for. So as a newcomer, the earlier that you can get credit, the better that it'll be for you long term when it comes to building your credit score. Types of credit, which accounts for 10%, refers to the different types of credit that you might have. So for example, there's credit cards, there's lines of credit, there's mortgages, and more. The last one is new credit, and this one accounts for 10%. Basically, if you've recently applied for multiple different credit cards or other forms of credit, it could impact your score because it could look like you're really trying to borrow money. The main things that you have to be aware of when it comes to your credit score are the things that are actually in your control. So 1 would be paying off your credit card on time and in full, and 2 would be keeping an eye out on your credit utilization. Also, remember earlier how we mentioned pulling your credit report and how banks and other credit companies report on your credit activity? Well, in Canada, there are 2 main credit bureaus called Equifax and TransUnion, and they're basically credit reporting agencies that compile all the information that's available about your credit history. They get this information from banks and other financial institutions that you have credit products with, and then those banks and financial institutions report to the credit bureaus any information about your credit activity. So, for example, it could be whether you've been paying your bills or your debts on time. And then what happens after that is that they then use that information and then they give you your credit score. You can actually check your credit score or pull your credit report once per year for free with each of the credit bureaus. So if you want one and you want to check your credit score or your credit history, don't buy one. It's free. Now, your actual credit score, that'll be a single number between the range of 300 to 900, depending on the credit bureau. And there are 5 different categories that your credit score could fall into. So that'll be poor, fair, good, very good, and then excellent. You basically want your credit score to be good, if not higher. As long as you're in the good range and above, you should be approved for whatever it is that your credit score is being reviewed for. Now, there are certain perks if your credit score is higher. So obviously, the higher, the better. If yours is low right now, don't even stress it because you can increase your score over time. I went from fair to excellent in the span of 2 years just from paying off my student loan debt and also properly paying off my credit card and being on top of it. Overall, credit cards are an important financial tool for building up credit, and you want to make sure that you have a good credit score. If you're looking for the right credit card, as a newcomer, you likely want to keep it simple and just stick to a no-fee credit card, likely with the bank that you have your checking account with. But in the future, once you've built up some credit history, then you might want to look into a different rewards credit card that actually meets your different spending needs at that point in time. But for now, simple is absolutely the way to go.
Now, before we go any further, we need to take a second to break down another system that we have in Canada, the tax system. Now, it's no secret that when it comes to taxes, we have some of the highest taxes in the world relative to our GDP, especially when you compare us to our neighbors in the United States. One of the first experiences that you'll likely have with direct taxes, so you having to give your share of taxes to the government, is when you get your first paycheck and you see how much money you've made, so your salary, minus any taxes that you have to pay. Now, something that's important to note here is that a lot of the taxes in Canada do go towards social programs, so depending on your personal situation, you might have actually already seen our tax dollars at work, but we'll talk more about that in a second. Despite feeling negative about seeing money come off of your paycheck and also hearing the complaints from some of the people around you, taxes are essentially the glue that keeps our society, economy, and the government running. Now, we don't always see the direct impact because a lot of the time we don't know where our tax dollars go, and sometimes it might also be going towards things that we wouldn't even think twice about, but this money, or at least some of it, is going towards things that we interact with daily. Now, we're not going to go super deep into the overall Canadian tax system because that could be an entire video on its own, but here are some of the high-level things that are important for you to know. Now, when it comes to your income, there are three main types of deductions that you'll see on your paycheck or your pay stub, which is basically the breakdown of the work that you do. And when I say deductions, I mean that when you get your paycheck, you'll see the total amount of money that you made for the work that you did, and then below that, you'll see various different taxes being deducted or taken away from that amount. There are specific percentages that are taken off for federal and provincial taxes. Now, this is money that you give to the government to pay for things that our entire country needs. Then there's also a line for CPP, which is the Canada Pension Plan, and also EI, which is employment insurance. CPP is something that everyone over the age of 18 has to pay into unless you live in Quebec, and it's basically a pension plan that's meant to give everyone who pays into it a little bit of money to supplement their retirement savings once they actually retire. So basically we pay into it now, and then in the future when we're no longer working, you can take money out of it. Now, EI is a program that provides temporary income support to anyone who becomes unemployed. We all pay into it, and then if we meet certain criteria, we can benefit from it while we're looking for a new job, or if you're pregnant, or if you're acting as a caregiver. So what happens to all of these taxes that are being collected for the federal, provincial, CPP, and EI deductions? Well, your employer ensures that this money goes to the CRA or the Canada Revenue Agency. They collect this money to pay for the government's operating expenses and also delivery of services. So making sure that the government's running and also paying for social programs, for example. Taxes are how we have public hospitals, schools, the military, the police force, libraries, roads, prisons, the CBC News. And what separates our system from a lot of other countries is that our government redistributes a lot of these taxes to low-income families and vulnerable Canadians in the form of different benefits. So we have child benefits for people who have kids, we have unemployment insurance for people who've lost their job, we have old age security for older Canadians who've lived here for a set amount of years, and the list goes on. Now, the tax system that we have in place is called a progressive tax system. That means that the taxes that we pay aren't the same for everyone. If you make less money, you pay less taxes on your income for the most part. Now, our income is also divided up into different brackets, and depending on what bracket you fall into, that will impact the tax rate that's applied to you. So for example, if you make a salary of $60,000 per year, $55,000 of that will be taxed at 15%, and the remaining $5,000 will be taxed at 20.5%. So you can see that as people earn more money, they're taxed at a higher rate on some of that money, and people who earn less money pay less in taxes.
Now, when it comes to investing, there's honestly so much stuff that we could cover, but the first thing that we want you to know is that before you even start to think about investing, we want you to make sure that you've taken care of all of the other financial building blocks that we've covered today. So that includes getting set up with a bank account, specifically your checking account, building up some savings in a savings account, understanding how the credit system works and getting started on building your credit. And then overall, just being more aware and just tapped into how the overall Canadian financial system actually works. Once you've gotten to that place and you have the income to put some money towards investing on a consistent basis, then that's a very important step that will actually set you up for the future and hopefully ideally allow you to build wealth over the long term. We recommend starting with our video called How to Invest Your First $1,000, and then from there moving on to our playlist called Investment Accounts Explained, which is basically like a very extensive playlist of all of the different accounts that we have here in Canada. For now, in this video, we're going to cover the steps you'll need to take in order to invest in the stock market in Canada.
The first step that you need to take once you're ready to start investing is picking an investment platform. Now, you can invest with one of the banks that we were talking about earlier, and there are a lot of people who do invest with the same financial institution that they have their other accounts with, but the thing to keep in mind is that they typically charge really, really high fees. And we don't want you paying those fees, especially when there's other options out there that are definitely better from a cost perspective and are also very safe, secure options as well. We personally use platforms called Wealthsimple and Questrade to invest. Now, it doesn't matter what specific platform you end up going with, but in general, we want to ensure that you're paying low fees. The next step you need to take is picking an account that you want to invest your money inside of. Kind of picture it like a flow chart here. So first you pick your platform and then you pick the account that you want to invest in. In Canada, there are two main types of investment accounts. There's registered or tax advantaged accounts, and then there's non-registered or taxable accounts. Now, what we want you to know from a high level for now is that you want to use your tax advantage accounts first because those are the ones that let you keep more of your money because you end up paying less money in taxes. The three main tax advantaged accounts that you'll want to look into first are the TFSA, RRSP, and FHSA. Now, the TFSA and RRSP are best used for long-term investing, so investing for your retirement, and then the FHSA is for investing to buy your first home. The last step is to actually pick and then purchase investments within the investment account that you choose. So again, if we're adding this onto our flowchart, you first pick your platform, you open the account, you put money into the account, and then you actually use that money to buy specific investments. Some investment options include stocks, which are tiny pieces of a company, or funds, which are like a basket of multiple different stocks all put together for you. Now, the other videos that we mentioned earlier go much deeper into all the different investment account options available in Canada and also different actual specific investment options as well. So make sure that you just use this as like a high-level base for your research and then go check out those videos for more deeper research and information.
So the last thing we want to touch on is the idea of getting ahead with your money and getting a real head start with your financial journey. In order to do that, you have to avoid lifestyle creep. This is when your expenses go up every time your income goes up. Now, hopefully, over time, your income is going to continue to go up, whether that's from you getting better, aka higher paying jobs, from you doing side hustles, or from your salary and just your general pay just going up over time. But here's the thing. If every time your income goes up, you spend more money, then you're never really gonna get ahead. Now, lifestyle creep can happen to anyone regardless of where they're starting from, and it often occurs when your wants and honestly your dreams for your life aren't in line with where you currently are financially. A lot of people, including newcomers to Canada, often envision the middle class dream, which typically involves having this picturesque dream house with a couple cars or whatever parked outside. As much as it can be possible to attain those things for some people, focusing solely on brand new material items, especially as a newcomer to Canada, is one of the reasons why household debt levels across the country are at an all-time high, especially when you consider how expensive basic items like food, housing, and transportation costs just are across the country. For my own family and a lot of newcomers, when we first arrived to Canada, we pretty much almost exclusively shopped at No Frills and Food Basics because they had the best bang for your buck and they provided the most value. And we also took public transportation pretty much everywhere we went. When it came to housing, we also went for what was most affordable, knowing that we were sacrificing certain things, but we also knew that it was smart to do that because it allowed us to get our feet just on the ground. Where lifestyle creep starts to literally creep in is as you become more accustomed to how things work and where you're at financially and also socially. So maybe it's you being at work and seeing where your coworker shops, or kind of like what I mentioned before, maybe you get a raise at work and all of a sudden you start to change up your habits. Making some changes to your lifestyle isn't a bad thing. It's actually very natural. The goal is to grow your income so that you can get your family into a home that actually, fits them, or even buying a reliable car that gets you from point A to point B if you actually need that car. All of these upgrades make sense and are important, but when we're talking about managing your money properly, you don't want to be going above your means. So for example, buying a house or renting a place that takes up more than 50% of your monthly income, or getting a car where the payment or all the costs take up more than 50% of your monthly income. None of those are good ideas. When it comes to buying a car specifically, there are a lot of costs involved that I don't even think a lot of people even think about. So obviously you first have to buy the car, right? Which could be in cash, leasing, or financing, right? There's that part. And then there's also all of the other monthly recurring costs, which could include your fuel, your maintenance costs, your license and registration, and I could keep going and going and going. If you need a car, then go ahead and buy one, but we want you to make sure that it's as low cost as possible. In general, the biggest costs for everyone, not just newcomers, are housing, transportation, and food. So if you can find a way to keep those costs down to a minimum, then you should be golden.
Now, before we wrap up, I want to take a second to talk a little bit about scams and also predatory loans or payday loans. Now, this is an extremely important topic because unfortunately, as a newcomer to Canada, you are a target for scammers who want to take advantage of you. Now, at a high level, if you receive text messages, WhatsApp messages, calls even, from anyone who's asking you if you want a job, that is a scam. Make sure that you do not answer them, do not give them any of your personal information. On top of that, if someone ever calls you saying that they're from the CRA or that they're from a bank and that you did something wrong and they need to confirm your information, you should hang up immediately because that's also likely a scam. Now, if you ever want to double check and see if it actually was, you can always call your bank directly after you've already hung up that call. Call your bank directly from the number that's on the back of your card, or you can call the CRA from the number that's on their website. Now, when it comes to payday loans, we have an entire video all about this topic, so please go check it out after this one. We'll make sure we link it for you. But in general, if you ever see a sign or a website that says cash for now, cash for you, Money Mart, payday advances, just make sure you stay away from them because it can be extremely hard to come out of the debt trap that those organizations can put you into. And that's officially everything that we're covering in this video. Now, there's so many different topics to learn about and dig into more as a newcomer in Canada, but hopefully this gave you a good overview of some of the most important topics out there. And remember that we have so many different videos on our YouTube channel that go more in depth on every single one of these, so make sure you check those out after this. We also have more videos coming every single week, so make sure you subscribe and stay tuned for more.